There is a line on your Schedule SE called your net earnings from self-employment, and the IRS uses that number to calculate a 15.3% tax that most people who work for themselves have never heard described by name. It is called self-employment tax, and it is entirely separate from federal income tax, which means it runs on top of whatever bracket you are already in calculated first, before any of your income deductions are applied. The average first-year freelancer earning around $80,000 owes roughly $11,300 in self-employment tax alone, and most of them find that out for the first time when the bill arrives. The behavior that leads to that bill is completely ordinary. You left a job, or you started taking on freelance work alongside one, and you continued thinking about taxes roughly the way you always had, setting aside a percentage of what you earned based on your income bracket and calling it covered. That approach works when an employer is quietly paying half of your Social Security and Medicare contributions every pay period on your behalf. The moment you work for yourself, that employer half disappears and you owe the full 15.3%. But nothing in your bank account, your invoicing software, or your tax return preparation flow tells you that until after the calculation has already been made. The misconception that creates the gap is specific. Most self-employed people believe that tracking income carefully and setting aside money for income tax is the whole job. It is not, because self-employment tax is a separate obligation calculated on a separate schedule using a separate rate, and the strategies that reduce it are also separate from the standard deductions most people know about. By the end of this video, you will know exactly what those strategies are, in the order a CPA would apply them, and you will be able to walk into any tax conversation knowing which of them applies to your income level and which does not. Before we go any further, everything covered in this video comes directly from IRS publications and the U.S. tax code, all of it public information. This is financial education, not personal tax advice for your specific situation, and before you act on any of it, take it to a CPA who works primarily with self-employed people, because the strategies here are real, but how they apply to your income, your structure, and your state matters, and that is what a professional is for. With that said, you deserve to walk into that conversation knowing what to ask for. This video covers 5 things in order: what self-employment tax actually is, and why employees never feel the full weight of it; the S-Corp salary structure that lets you legally reduce the income subject to this tax, which is the strategy CPAs charge the most to explain; a deduction called the QBI deduction that most people filing their own taxes never claim, and that can eliminate tax on 20% of your eligible income; why retirement contributions are not just a savings strategy, but a way to legally move income out of the IRS's reach right now; and a health insurance deduction that self-employed people are entitled to in full, but that most tax software quietly underserves. And then at the end, a reframe that changes how you think about all of this going forward. When you worked a regular job, 2 taxes came out of every paycheck before you ever saw the money: Social Security tax and Medicare tax. Together, those 2 are called FICA taxes, which stands for the Federal Insurance Contributions Act, though the name matters less than what the taxes actually are. Social Security tax funds the Retirement Benefit Program, and Medicare tax funds the Federal Health Insurance Program for people over 65. Together they add up to 7.65% of your wages, and if you looked at a pay stub from a previous employer, you saw that 7.65% coming out under a label like FICA or SS/Med, which probably felt annoying but manageable. What your pay stub never showed you was the line right next to it, where your employer paid an identical 7.65% on your behalf, directly to the IRS, and you never saw it because it never touched your paycheck. Think of it like a restaurant bill where you and a friend agreed to split it down the middle. You paid your half, your employer paid their half, and the IRS collected the full amount. The total tax on your wages was 15.3%, but because your employer covered half, you only felt 7.65%. That arrangement is called employer-matched FICA contributions, and it is one of the most significant financial benefits of traditional employment that almost no one thinks about until it disappears. When you become self-employed, it disappears, and you are now both the employee and the employer. The IRS still expects 15.3%, but there is no one to split the bill with, so you pay the employee half, and you pay the employer half, on your own, on top of your federal income tax. That full 15.3% is self-employment tax, and it applies to the first $176,100 of your net self-employment income in 2026. Verify current figures at irs.gov because this threshold adjusts each year. Above that threshold, the Social Security portion stops, but the Medicare portion of 2.9% continues on every dollar earned above it. And if you earn above $200,000 as a single filer, an additional 0.9% Medicare surtax applies on top of that. To put real numbers on this, if you netted $80,000 from freelance work last year, your self-employment tax bill was approximately $11,304 before a single dollar of income tax was calculated. That is not a penalty, and it is not the IRS being unfair to freelancers. It is the cost of no longer having an employer absorb half of a contribution you were always making. The IRS did, however, build several mechanisms specifically to reduce this number, and the people who use them are paying dramatically less than the people who do not. There is one small offset the IRS does allow. You can deduct half of your self-employment tax from your gross income before your federal income tax is calculated. That does not reduce the SE tax itself, but it does reduce the income number that federal income tax is applied to, and on $80,000 of net self-employment income, that deduction is worth roughly $5,652, which saves you somewhere between $1,200 and $2,200 in federal income tax, depending on your bracket. It is a partial relief valve, not a solution, and the strategies that follow are the actual solution. The strategy that CPAs working with self-employed people explain in their first paid consultation, and that most freelancers never encounter until years into their business, involves a business structure called an S-corporation, and the first thing to understand is what that actually means. An S-corporation is a legal business structure you elect with the IRS that changes how the government taxes the money your business makes. By default, when you freelance as a sole proprietor or as a single-member LLC, every dollar of profit your business earns is treated as your personal income for Southeast tax purposes. The IRS sees all of it as earnings from self-employment, applies the 15.3% rate, and bills you accordingly. An S-corp changes that equation by splitting your business income into two categories: a salary you pay yourself and a distribution, which is the remaining profit passed through to you as the owner. The split matters because of one critical rule. Self-employment tax only applies to the salary portion, and the distribution portion, the profit that flows to you as an owner above and beyond your salary, is not subject to SE tax. So if your business makes $100,000 in profit and you take all of it as self-employment income, the IRS calculates SE tax on $100,000. But if you structure it as an S-corp, pay yourself a $60,000 salary, and take the remaining $40,000 as a distribution, the IRS calculates SE tax only on $60,000. That difference saves approximately $5,652 in Southeast tax alone in a single year. The number you need to know is the reasonable salary rule, which says the IRS does not allow S-corp owners to pay themselves a nominal salary just to minimize SE tax. If you are an active participant in your business, the salary you pay yourself has to be reasonable for the work you are doing, meaning it should be comparable to what you would pay an employee to do the same job. An attorney who bills $200,000 a year and pays herself a $15,000 salary while taking the rest as a distribution is going to attract IRS scrutiny, while an attorney who pays herself $100,000 and takes $100,000 as a distribution is on much firmer ground. The IRS has tools for auditing this, and a CPA who works with S-corp will help you establish a defensible salary, which is one of the places where professional advice genuinely earns its fee. The cost to consider is complexity. An S-corp requires its own payroll, its own tax return on Form 1120-S, and ongoing compliance that a sole proprietorship does not, and the setup cost varies by state, but typically runs between $500 and $2,000 in formation and first-year accounting costs. The break-even point where this structure makes financial sense is generally around $50,000 to $60,000 in annual net self-employment income, because below that threshold the compliance costs tend to outweigh the SE tax savings, while above $60,000 the savings compound quickly. At $150,000 in net profit with a $75,000 reasonable salary, the SE tax savings over the distribution amount to roughly $10,633 per year every year legally. You can elect S-Corp status for an existing LLC without forming an entirely new entity by filing Form 2553 with the IRS. There are deadlines and retroactive election rules that a CPA can navigate for you, but the point is that you do not necessarily have to start over with a new business to access this structure. In 2017, Congress passed a provision called Section 199A that created a deduction for business owners who earn what is called pass-through income. Pass-through income is business profit that flows directly to your personal tax return rather than being taxed at a corporate level first, which describes how virtually every freelancer, sole proprietor, and single-member LLC owner gets paid. You earn money through your business, it passes through to your Form 1040, and you pay tax on it personally. Section 199A says that if you qualify, you can deduct 20% of that business income before your federal income tax is calculated. To be concrete about what that means, if your qualified business income is $80,000, you can potentially deduct $16,000 from the amount the IRS uses to calculate your federal income tax, which is worth approximately $3,520 at the 22% bracket and $3,840 at the 24% bracket. This is not a credit, which would reduce your tax dollar for dollar, but a deduction, which reduces the income number tax is applied to. The distinction matters, but either way, it is money that stays with you rather than going to the IRS. The deduction has income limits that matter. For 2026, the full 20% deduction is available to single filers with total taxable income below $197,300 and married filing jointly filers below $394,600. Verify these figures at irs.gov because they adjust for inflation annually. Above those thresholds, the rules become more complex and phase-outs begin to apply, particularly for what the IRS categorizes as specified service trades or businesses, a category that includes law, health, consulting, financial services, and certain other professional services where the principal asset of the business is the skill or reputation of the owner. If you fall into that category and your income is above the threshold, the deduction may be reduced or eliminated entirely, and a CPA's guidance becomes important. If your income is below those thresholds, this deduction is available to you, and the reason it gets missed is surprisingly mundane. Most DIY tax software handles it inconsistently, with some programs claiming it automatically when the conditions are met and others requiring you to navigate to a specific section and confirm your eligibility manually. Taxpayers who file quickly, who do not review every deduction screen, or who use older software versions sometimes miss it entirely, and there is no notice from the IRS saying you left money on the table. If you have filed your own returns in recent years and are not certain whether you claimed this deduction, it is worth reviewing those returns with a professional. If you find this kind of information useful, a subscription keeps more of it coming. This channel posts tax and financial education for self-employed people every week. The conventional framing for retirement accounts is that you put money away now so you have it later, and that framing is accurate, but it misses the more immediate reason a freelancer should care about these accounts in the year they are contributing to them. Every dollar you put into a qualifying retirement account this year is a dollar that does not appear on this year's tax return as income, subtracted from the number the IRS uses to calculate both your income tax and, depending on the account type and your business structure, a portion of your self-employment tax base. A SEPIRA, which stands for Simplified Employee Pension Individual Retirement Account, allows self-employed people to contribute up to 25% of their net self-employment income, with a 2026 maximum contribution of $69,000. Verify this at irs.gov as it adjusts annually. Those contributions are fully deductible as an above-the-line deduction, meaning they reduce your adjusted gross income before any other calculation begins, like subtracting from the sticker price before any discount is applied on top of it. There is no Roth option with a SEPIRA. Contributions come out pre-tax, and withdrawals in retirement are taxed at that future rate. But the account can be opened through most major brokerages with minimal paperwork, and contributions can be made up to the tax filing deadline for the year in question, including extensions. A solo 401k is available to self-employed individuals with no full-time employees other than a spouse, and it has a dual contribution structure that allows for larger total contributions at lower income levels. You can contribute as an employee up to $23,000 for 2026, and as the employer contribute an additional amount up to 25% of your net self-employment compensation, with the combined total capped at $69,000. Again, verify at irs.gov. Unlike a SEP IRA, a solo 401k also allows Roth contributions, which means you can choose to pay tax on the money now and withdraw it tax-free in retirement. The setup requires a plan document, which most major brokerages provide at no cost, but the account must be established by December 31st of the tax year, not by the filing deadline. To make this concrete, a freelancer who nets $100,000 and contributes $20,000 to a SEP IRA reduces their adjusted gross income to $80,000 before income tax is calculated, and at the 22% federal bracket, that contribution alone saves $4,400 in income tax. The $20,000 is not gone. It is in an account growing tax-deferred, but the immediate effect on this year's tax bill is real, and it is one of the few legal mechanisms available to a self-employed person for reducing taxable income that also builds long-term net worth simultaneously. Self-employed people pay their own health insurance out of pocket, and in most of the country that cost runs between $400 and $800 a month for an individual plan, more for families. What a significant portion of people filing their own returns do not know is that those premiums are fully deductible from gross income as an above-the-line deduction, which, to use the same framing from earlier, means they reduce the starting number before any other calculation happens. This is not the same as itemizing deductions, and you do not have to itemize to claim this. It is claimed directly on Schedule 1 of Form 1040 and reduces both your adjusted gross income and your federal income tax. The qualifying conditions are specific. You must not be eligible for coverage through an employer-sponsored plan, either your own or your spouse's, for the months you are claiming the deduction, and if you had access to employer coverage and declined it, the IRS does not consider you eligible for this deduction during that period. The deduction covers premiums for medical, dental, and long-term care insurance, and it extends to cover your spouse, dependents, and children under age 27, even if they are not your dependents for tax purposes, though it cannot exceed your net self-employment income for the year. On $6,000 in annual health insurance premiums, this deduction saves approximately $1,320 in federal income tax at the 22% bracket and $1,440 at the 24% bracket. Taxpayers who claim it through their software without confirming it was calculated correctly, or who miss it entirely because the software presented it ambiguously, leave that money on the table every year with no notification from the IRS. If you are self-employed, paying your own health insurance, and not certain this deduction appeared on your last return, check Schedule 1, line 17. There is a version of this topic that circulates in freelancer forums and YouTube comment sections, and it sounds like this. You need to form an LLC to save on taxes. It is one of the most expensive pieces of well-meaning misinformation in the self-employed space, because it is true in one narrow way and completely false in the way most people interpret it. A single-member LLC is what the IRS calls a disregarded entity, a phrase that means exactly what it sounds like. The IRS does not recognize it as a separate taxpayer. For federal income tax purposes, a single-member LLC is treated exactly the same as a sole proprietorship, with the business's profit flowing through to your personal return, reported on Schedule C, and self-employment tax calculated on the full amount. The LLC structure does not change any of that, and does not reduce your SE tax by a single dollar. What it does do is create a legal separation between your personal assets and your business liabilities, which is genuinely valuable protection, but it is a legal benefit, not a tax benefit. The tax benefit comes when you add a specific election on top of the LLC structure, namely the S-Corp election described earlier, which changes how the IRS classifies your income and creates the salary versus distribution split. The LLC itself is the legal container, and the S-Corp election is the tax instrument. They are different things that people frequently conflate, and conflating them leads freelancers to form an LLC, feel like they have handled the tax situation, and continue paying SE tax on every dollar they earn while the clock runs on years of potential savings. If you already have an LLC and have not made an S-Corp election, that structure is available to you without dissolving and reforming anything through Form 2553, which has retroactive options depending on your timeline. A CPA familiar with S-Corp elections can walk you through whether the timing and income level make it worthwhile. The first thing worth doing before anything else is calculating what self-employment tax is actually costing you right now, because all of the strategies above become more or less urgent depending on that number. Take your net self-employment income from last year's Schedule C, multiply it by 0.9235, which is an adjustment the IRS requires that accounts for the deductible half of SE tax, and then multiply that result by 0.153. That is your approximate SE tax bill. And for most people who have never done this calculation explicitly, the number is larger than expected. Seeing it clearly is what turns these strategies from abstract concepts into decisions worth making. If you find this kind of breakdown useful, subscribing means you get more of it. This channel posts every week for people navigating self-employment finances without a team of accountants behind them. The second step is to review the last 2 or 3 years of your returns to confirm whether the QBI deduction and the self-employed health insurance deduction were claimed, both of which appear on Schedule 1. If they were not claimed in years where you were eligible, amended returns are available for up to 3 years back using Form 1040-X, and recovering 2 to 3 years of missed deductions on those 2 items alone can be a meaningful dollar amount. A CPA can review your prior returns in a single consultation and tell you definitively whether an amendment makes sense. The third step is to determine whether your income level makes the S-Corp election worth pursuing, and the general rule of thumb used by most CPAs is that the strategy typically begins to pay off around $50,000 to $60,000 in annual net self-employment income after deductions, because that is the point where the SE tax savings begin to outweigh the additional compliance costs. If you are above that threshold and have not explored this, the gap between what you are paying and what you could be paying compounds with each additional year. The fourth step involves retirement accounts. If you do not currently have a SEPIRA or solo 401k, opening one this year means contributions made before the tax deadline can reduce this year's tax bill, and the SEPIRA specifically can be opened and funded up to your filing deadline, including extensions, which in practice can mean September of the following calendar year. You are not committing to a specific annual contribution, as the amount can vary year to year based on income and cash flow. The fifth step is the one that compounds everything else. Find a CPA who works specifically with self-employed people, not just a general tax preparer, who also handles W-2 filers during tax season. The strategies in this video are real and well documented, but the sequence in which they apply, the interaction between your business structure and your state's tax treatment, and the specific defensible salary for an S-Corp election all require someone who understands the self-employed client's situation from a year-round perspective. The cost of that relationship typically runs between $1,500 and $4,000 annually for a straightforward self-employed client, and tends to pay for itself in the first year if you have not been using one. Self-employment tax is not a punishment, and the strategies that reduce it are not loopholes. The IRS wrote Section 199A, Congress authorized the S-Corp salary structure, and the self-employed health insurance deduction and the retirement contribution deduction are built into the tax code specifically because policymakers recognize that self-employed people carry costs that employees do not. The system was designed with these instruments in it, and the people who use them are not doing anything clever or aggressive. They are using the tax code the way it was written to be used. The shift in thinking that makes the biggest difference is this. Your goal is not to file a return that accurately reports income and then hope the bill is manageable. Your goal is to structure how your business earns and distributes income so that the number the IRS starts with is as small as it legally can be before any rate or bracket is applied. Every strategy in this video operates at that level because S-Corp distributions, retirement contributions, and above-the-line deductions all reduce the starting number. The rate never changes, the bracket never changes, and the starting number is the only thing you can actually influence. If any of this opened a question about your own situation, leave it in the comments. This channel answers tax and financial questions for self-employed people every week, and the most specific question you ask is the one that helps the most people reading the thread after you. Subscribe if you want the next video in this series, which covers the home office deduction in the same level of detail, including the simplified versus actual expense method, and which one is usually worth more than people think.